One handle, two platforms. That handle is the only fingerprint they can't forge. If anyone DMs you for money, wallets, VIP access, or signals, it's a scam. I sell nothing. Ever. Now type weapon in the comments if you're locked in, because the Strait of Hormuz just went from headline risk to functional shutdown, oil ripped, and silver dumped, and most people still don't understand why those can happen on the same day. Stop. This matters. Quick transparency before we start. I could not open your financial post link from my side, non-retriable error, so I can't quote it directly. I can extract the full key facts from your MITRADE FX Street source, and I'll corroborate the Hormuz disruption context with other reputable outlets reporting the same event so the script stays grounded. Now listen, your title is perfect because it sounds like a contradiction. Strait of Hormuz shut. Oil plus 10%, but silver dumped 6%. The dollar weapon exposed. Most people hear that and think, that makes no sense. War should make everything hard go up. That's a calm market mindset. This is not a calm market. This is a stress market. And stress markets trade in layers. Oil is the necessity shock. Gold is the trust hedge. Silver is the high beta hedge that gets punished when liquidity tightens. And the US dollar is the weapon, not a conspiracy weapon, a structural one. Because when the world panics, everybody needs dollars to settle energy, shipping, insurance, and margin. So the dollar tightens the noose first, and silver feels it hardest. Now let's extract the hard facts from your MITRADE source, because it lays the entire chain out clean. MITRADE, sourcing FX Street, reports West Texas Intermediate surged more than 6%, broke above $75, and traded around 76.16, its highest level since June 2025, as the U.S.-Iran war raised fears of supply disruptions through the Strait of Hormuz. They state the Strait of Hormuz handles around 20% of global oil shipments, making it one of the world's most important energy choke points. They report senior officials from Iran's Islamic Revolutionary Guard Corps declared the strait closed and warned any vessel attempting to pass could be set ablaze. They also say ship owners have largely halted transit, with vessels anchored outside the strait. Then they add a second shock. Saudi Aramco suspended operations at Ras Tanura after a drone strike. The facility can process about 550,000 barrels per day. And Reuters attributed analysis via their source says Goldman Sachs estimates an $18 per barrel real-time geopolitical risk premium in oil prices, potentially moderating to about $4 if only 50% of flows are disrupted for a month. That's the oil spike. That's the why. Now the question your title forces, how do you get oil ripping on a supply shock? While silver dumps? Here's the answer in one line. Oil up is an energy shock. Dollar up is a liquidity shock. Silver down is a leverage shock. Same war, same day, different forces. Stop. Let me explain this the clean way. A Strait of Hormuz shutdown isn't just bad news, it's a pricing event, because around 1/5 of global seaborne oil flows through that narrow passage. And here's the part most people don't map. Hormuz doesn't have to be closed on paper to be closed in practice. It closes when ships stop moving. It closes when war risk insurance disappears. It closes when owners anchor and refuse to transit. The Guardian reports major maritime insurers canceling war risk cover in the Gulf and around Hormuz, with vessels halting operations and premiums surging. So oil moves fast because oil is necessity. You can't paper your way out of missing barrels. Now, why silver dumps? Because silver is the most misunderstood asset in this entire war regime. Silver is not just a metal. Silver is a positioning vehicle. And in a war tape, positioning gets punished. Here's the hidden sequence that creates your title. Step 1, war shock hits, oil gaps up, gold gets a bid. Step 2, volatility spikes, risk desks tighten, margin calls spread. Step 3, the world scrambles for dollars, because dollars settle energy and margin. Step 4, silver gets sold, not because silver is bearish, but because silver is liquid and leveraged and becomes collateral. That's the dollar weapon, not a secret room, a settlement system. In stress, the world hoards dollars, and when dollars are hoarded, dollar-priced commodities get pressure. Silver gets the worst of it because it's thinner and higher beta than gold. Now stop. Pattern break. Most people think the market sells assets because it changed its mind. In stress regimes, the market sells assets because it needs cash. That's why the silver dump can happen on the same day oil is screaming scarcity. One is a supply shock. The other is a collateral shock. Now, your title says oil plus 10%. MITRADE snapshot gives WTI up more than 6% at the time of writing, and other mainstream reporting around this same event shows similarly dramatic spikes and higher intraday prints for Brent WTI depending on the timestamp. The exact percent varies by benchmark and time of day, but the point is stable. Energy risk premium exploded because Hormuz disruption is being treated as real. Now, Silver dumped 6%. That also fits the same stress logic we've mapped in earlier sessions. Silver can be the first thing sold when risk managers cut exposure and the dollar tightens. So what is the dollar weapon exposed in your title? It's this. Oil is priced in dollars. Shipping and insurance are priced in dollars. When war risk hits, demand for dollars rises, both as safe haven and as settlement currency. That pushes USD higher and tightens global liquidity. Tight liquidity forces liquidation in high beta assets. Silver is high beta, so silver gets hit first. Now let's bring the story back to Hormuz to show why this isn't just a one-day scare. Mitraid says ship owners halted transit and vessels anchored outside the strait. The Independent, citing trading sources, reports shipments being suspended and ships staying put for days in response to the closure reports. The Wall Street Journal live coverage described tankers diverting and staying out of the area after strikes. That's not a vibe, that's behavior. And behavior is what moves prices. Now here's where this gets dangerous for your audience, in a good way, because the same sequence that dumps silver can later launch silver. Here's why. If oil stays elevated and disruption persists, inflation expectations rise. If inflation expectations rise, real yields get pressured. If real yields get pressured and trust stays shaky, hard assets stay bid. Gold stays bid first. Silver whips. Then, if the stress persists long enough, silver can flip from collateral victim to scarcity bid. That flip is the entire game. So your video can't end at silver dumped. It has to end at what happens next. And we do that with the 48-hour checklist. But before that, we answer the question the audience will ask. Who benefited? Not names. Position types. Because blaming villains is entertainment. Understanding positioning is education. Here's who tends to benefit when oil spikes and silver dumps on the same day. Energy longs. Hedgers. Because oil reprices immediately when a choke point handling 20% of shipments is threatened. Dollar cash holders. Because in war-driven liquidity stress, cash becomes king. Gold first allocators, pure hedge first, messy hedge later. Volatility traders, because these regimes are gap machines. Who gets hurt? The people who treated silver like a safe haven identical to gold. Silver is not identical to gold. Silver is high beta. Now stop, pattern break again. War creates two simultaneous trades. The fear trade, gold, sometimes oil, and the cash trade, dollar, collateral, forced selling. Silver gets caught between them. That's why it whips. Now I'm going to give you the two scenarios that decide whether silver's dump is the end or the setup. Scenario A, disruption persists and the dollar stays strong. Oil stays elevated because flows remain disrupted. Ship owners keep hesitating, insurance stays tight, dollar stays bid because the world is hoarding liquidity. In that scenario, gold stays strong, oil stays strong, silver stays choppy and can remain pressured because the dollar weapon is still active. Scenario B, disruption persists but the dollar blinks. Oil stays elevated, but the dollar stops rising. Liquidity stress eases slightly. That's the moment silver can reverse violently, because the collar around silver's neck loosens. Silver is thin, so when it flips, it doesn't slowly recover. It gaps. Now, which scenario are we in? We don't guess. We watch. Here's your 48-hour checklist, binary and addictive. Oil hold test mid-range shows WTI breaking above $75 and trading around 76 on Hormuz risk. If oil holds most of the spike, disruption is being treated as persistent. If oil gives it all back, the market is calling it contained. Transit and shipping behavior. Do ship owners keep halting transit and anchoring outside the strait? Mitraid says they have. If that continues, the shock stays real. Dollar direction. If the dollar keeps rising, silver stays pressured even if your long-term thesis is bullish. If the dollar cools while oil stays high, silver can flip. Silver rebound speed. This is the single most important tell. When silver is slammed, does it bounce fast? Fast bounce? No, smart mechanical selling ending, plus buyers waiting. Slow bleed? Demand not committed. Gold versus silver leadership. If gold holds strong while silver starts outperforming on up days and refuses to underperform on down days, that's the phase shift into hard asset repricing. Now stop. Here's the final line that ties your title together. The Strait of Hormuz shock drives oil higher because energy is necessity. The dollar weapon drives silver lower because liquidity is necessity. And silver's job in the system is to expose the collateral stress first. That's why oil can be up 10% and silver can be down 6%. Same day, same war. This isn't financial advice. This is financial warfare education.